Before the break, I told you about a new Wall Street Journal report that lays out how a team of Trump allies are outlining new policy that would give him new power, if elected, to greatly affect monetary policy in the United States and erode the independence of the Federal Reserve. For more on this, I'm joined by Diane Swonk, chief economist at KPMG. In her role, Diane regularly briefs the regional Federal Reserve banks and its board of governors in Washington, D.C. She's previously served as an advisor to the National Economic Council. And Diane, I don't want to spend quality time with you, my old friend, talking about this the whole time, but I did want to sort of just discuss it for a moment, because I don't think everybody spends a lot of time thinking about the Fed and how their governors are appointed. But it's an important point that the Fed chair is not directly answerable to the president of the United States. They even have staggered terms and things like that. How important is it that we think about the fact that that could change?
I think it's very important, and it's, history is littered with examples of central banks that have been overtaken by leaders that are not happy with interest rates, and there's no shortage of them in our own history in the United States. In fact, Arthur Burns, who was appointed by the Nixon administration in part because he was seen as a loyalist to the Nixon administration, although he had to have his arm turned on that point, made a very famous speech that then became sort of Godspell for the overall central bank in the U.S., the Federal Reserve, and central banks everywhere. It was called The Anguish of Central Banking. And in that speech, he laid out the incredible risk of trying to lower interest rates just for the sake of juicing employment or reducing the unemployment rate when inflation and the battle against inflation had not been won. It was part of what led to the stagflation of the 1970s. And in the speech, he essentially laid out his own mistakes, and it's become a cardinal sin of central banking to do just that, to do for political gain. Any gain you get by lowering interest rates to lower unemployment rate is quickly reversed because inflation erodes it away, and then you can get a much more corrosive bout of stagflation with rising inflation and rising unemployment.
Is there any good side to the government being more involved in the Fed? Because I certainly see amongst conspiracy theorists lots of conversations about, the Fed's this entirely independent body that prints money and sort of controlled by a cabal of secret people and all that kind of stuff. It's not true. But is there any argument for more governmental control than the U.S. government has over the Federal Reserve at the moment?
Well, the Federal Reserve does answer to Congress, and that is something that's important as well, and Congress could change their mandate. The idea that we have a 2% inflation target is not a law. The idea that we have sort of very loose guidelines on what the Fed does is part of what is guiding the Fed at the moment, and that could be changed by Congress. So if they wanted to have more oversight, there are areas that they could do that. Most countries have gone towards more rule-based, kind of look at their central banks so that the central banks are even more independent in terms of the political pressures. Ultimately, what's best for everyone is for inflation to get down and the Federal Reserve to do its job in doing that with the least amount of consequences for unemployment as possible.
So let's look at this environment that we're in. There may be some Americans who would say we would like interest rates to be lower and mortgage rates to be lower, and we'd like the Fed to sort of lead that effort by lowering interest rates. And you've got Jay Powell saying, well, we're not sure we've got our handle on inflation as much as we'd like to right now. So those 3 interest rates that you thought you were getting might be 2, they might be 1. That's its own discussion, and I'd like your view on what do you think is going to happen to interest rates. But what's the consequence of having political motivations? Is it possible that a president could say, just lower the interest rates, buddy, I need to win an election?
Well, it has happened, like I said, in the 1970s, and that ended up with some disastrous outcomes. So it could happen. It's not unusual to have presidents be very angry with their head of their central bank. Paul Volcker was also not exactly liked for his pushback on deregulation of the banking industry. This is nothing new. Even Alan Greenspan, who was thought to be a lackey, ended up being much more independent than many of presidents that he worked for thought he would be. So I think it's really important that we push back on that idea, and we really want to get, at the end of the day, yes, it would be lovely to have 2019 prices and 2024 wages. Let's face it, we'd all love that. That's not a reality now. What we'd like to do is get inflation down, and it's the Fed's job to do that, and unfortunately, it looks like they're going to have to do that by holding rates higher for longer. But the threshold to raise rates is much higher than it is to cut rates. The Fed does think they're at a peak in rates. They will discuss the idea of having to raise rates again, but I think the next movement in rates will be down, unfortunately not till much later this year, and we're probably only going to get one cut by the end of the year.
One, as opposed to the three that we've been looking for. And we've seen a reaction in markets. A lot of people have been watching their 401ks and watching the stock market do very well in anticipation of a strong economy that's got low unemployment, lots of spending, but that interest rates would go down. How consequential is it that we may not see an interest rate cut until much later in the year for my viewers?
I think it's really important in the extent that the easing of financial conditions that we saw when the financial markets were going crazy, thinking we get up to 8 cuts at one point in time from the Federal Reserve at the turn of 2023 and early 2024, that did lower mortgage rates, and it did rekindle the dry tinder in the housing market. And in fact, home values started to pick back up again very rapidly. It really illustrates how much the Fed needs the bond market to work with it. So although it's not pleasant, the bottom line is if we can continue to slowly erode inflation without a major increase in unemployment, which I think is still very possible and probable, that is the best path, even though it's not the most comfortable for all consumers out there at the same time.
Diane, I knew I had the right person to talk to about this. Thank you again for joining me. We always appreciate having you on the show. Diane Swonk is the chief economist at KPMG, former advisor to the National Economic Council.